Options trading strategy. Why it's better to trade vertical credit spreads than naked options. David Jaffe with BestStockStrategy.com. You can visit BestStockStrategy.com, enter in your email address, and receive over $400 of valuable free training. In this video, we are going to discuss why it's better to trade vertical credit spreads as opposed to naked options. Trading spreads is actually something that is counter to the way that I used to trade. Up until about 6 months ago, I almost always traded naked options. However, recently I have started switching over to trading spreads. And the primary reason is that the increased capital efficiency and the tail risk protection from trading and selling spreads outweighs the increased amount of premium and the increased ease that you have when rolling and managing positions. So again, stated another way, I believe that the capital efficiency and the tail risk protection of turning that into a defined risk trade outweighs the small decrease in premium that you receive and also the increased difficulty that you will have when rolling and managing a defined risk trade relative to a naked option. So this is probably the biggest way that I've actually changed my trading in 2019. I now primarily trade spreads as opposed to naked options. And actually, I trade spreads with virtually every single security. So before, I used to only trade spreads with a very expensive security like Amazon or Google just for capital efficiency purposes. But now I believe that trading spreads provides you with a substantial advantage. It is more capital efficient. And additionally, it provides you with tail risk protection. As an example for the capital efficiency, your broker, now again, okay, let's use 100 shares of stock, 100 shares of naked options, and 100 shares of one contract of a $5 wide spread. If a stock is trading at $100 and you buy 100 shares, your broker is going to reduce your buying power by $5,000. So you buy 100 shares of $100 stock, that is a notional value of $10,000. Therefore, based upon Regulation T, your broker is going to reduce your available buying power by $5,000. If you sell a put with a strike price of $100, that allows you to control an option or 100 shares of the underlying stock at a price of $100. So it is, for all intents and purposes, similar or comparable to buying and going long 100 shares of stock. Your broker is going to reduce your buying power by 12 to 20%. It depends upon the calculation, but let's just estimate it and say 15%. So remember, by buying 100 shares of stock, your buying power is going to be reduced by $5,000. By selling one naked put option with a $100 strike, your buying power is going to be reduced by about $1,500. If you sold a $5 wide vertical credit spread, you would sell the 100 strike, you would buy the 95 strike, and let's say you would collect around $1 of premium. That means that the broker would reduce your buying power by only $400 because brokers reduce buying power with spreads on the maximum loss, which would be $500 per contract, less the credit received. So that would be $400. So again, if you buy 100 shares of stock, your buying power is going to be reduced by $5,000. If you sell a naked put, your buying power in this example is going to be reduced by $1,500. If you sold a vertical credit spread, your buying power will be reduced by $400. That means that the spreads are about 4 times more capital efficient than selling a naked option. And in this case, they are about 12 times more capital efficient than stock. And you have the incremental benefit of turning it into a defined risk trade and limiting your downside. So if the stock fell to $80, then the maximum amount of money that you could lose on a net basis, factoring in the premium that you received for the vertical credit spread, would still only be $4 or $400 per contract that you sold. This is one of the major changes that I've made to my trading over the past 6 months, and you can learn more about it by going to beststockstrategy.com/memberships. You can go and visit beststockstrategy.com enter in your email address and receive over $400 of valuable free training. My students consistently make money in this by trading options. You will learn how to be a consistently profitable options trader. Leave a comment below and let me know your thoughts on whether you believe it's better to trade spreads or whether you still believe it's better to trade naked options. The one caveat is that it's very important for you to not substantially increase your size. So even though in this example that I provided you, trading a spread is 4 times as capital efficient as trading a naked option, that should not permit you to then sell 4 times as many spreads as you would have traded naked options. So for example, if you were going to trade 5 naked options, if you were going to sell 5 naked options, you should not go out and sell 20 vertical credit spreads. That is the biggest mistake that I see people who end up losing money by trading options. They just simply trade too big. David Jaffe from BestStockStrategy.com. Please leave a comment below. I respond to everyone's comments and I look forward to reading your thoughts on whether you believe it's better to trade spreads or whether you still believe it's better to trade naked options.